The oil price, which is pretty much unchanged, $82.31 a barrel on your screen. There's certainly not much of a move for that oil price overnight, ending that New York session just 8 cents weaker as you had a stronger dollar, encouraging US data, and rising US fuel supplies, all throwing up really some conflicting signals to the oil market. There is one thing everyone seems to agree on, though, and that's that the oil price has remained remarkably resilient in recent times, despite all the negative commentary that's been around about the global economic recovery. Peter Maguire's from CWA Global Markets. He joins me in studio today in Sydney. Jonathan Barrett from Commodity Broking Services joining us from the CBD camera. Good morning to both of you. And Jonathan, first to you. In your recent commentary, you've been looking at this idea of why you can have such negative commentary and yet you can have that oil price remaining very resilient. What's the best explanation you've come up with?
Yeah, Brooke, it's been quite interesting because all the data we've had to date suggests that we are seeing certainly lifts in supply and not seeing any follow-through in demand. That has been a concern. A lot of commentators have mentioned that oil should be going lower, but yet a couple of days ago we broke through that 80.25 level and at 82.40. What I do think is that the market is positioning themselves for significant demand out of Asia. And I think, to me, that's one of the keys. I mean, a lot of people are starting to factor in the fact that Asia is growing and will commence to grow. Comments from Chinese Premier suggested looser monetary policy. And on the back of that, I think you're going to continue to see that support from Asia. And on the back, we'll probably see oil continue to trade higher. But
doesn't a slowing down of China, which we expect, everyone expects that, doesn't that mean less energy consumption?
When you look at it, Brooke, China's been slowing down for some time. When you can see where CPI has been, where GDP, manufacturing, it's all coming down. Now, that's okay because that's what's actually reported in the press. But what we do find is we start to see an uptick in demand, an uptick in the freight rates, iron and ore, coal prices, all starting to tick just a little bit higher. And these are the early signs that these economies are about to have another lift. You won't see it in the press, but what we see is on the coalface, literally, that prices are starting to tick up, demand for steel starting to pick up, and that suggests that they're ready to have another expansion phase. And
Peter Maguire in Sydney with me, the US dollar, that's dropped about 10% from recent highs, so obviously that becomes more attractive for foreign buyers. Can you see in the charts when you look at them that US dollar impact?
Well, Brooke, I mean, you know, you roll it across. Good morning, Jonathan. A couple of quick things. First off, the yen's nearly at 15-year highs against the dollar. Yeah. And the dollar, we're looking at, you know, now through, well, closing in on that 80 range.
Why doesn't anyone want to hold the yen at the moment?
Well, why don't they want to hold it? It's a low interest rate environment. It's very, very volatile as far as the currency is concerned, but I think more will jump into it. There's no doubting that, but it's very a disadvantage play naturally for Japanese producers and exporters. So that's the great challenge for that country. But you either get one going up or one going down, and where the euro's at the moment, crude prices, I think it's the proxy trade. The smart money jumped into it at 74, 75. They've put on about $8 and it's been a great trade. They dumped gold and bought crude, and now they're all starting to come back up, along with some of the agricultural.
So the crude oil price has been very much supported by that US dollar. Yep. There's a huge bias against the US dollar generally, and understand the market's still pretty short US dollars. What's the risk to that, though? Because obviously if that US dollar reverses, then this oil price comes back, right?
It'll reverse one day, Brooke, but I think, you know, the euro was hit very, very hard. It went down to around 121. Crude prices dropped off as well, and then the US dollar has since bounced back. Or pardon me, since retreated, the euro's bounced back, and crude's had a best part of a 10%, 12% rally in the last couple of weeks. So it's been very, very strong.
Jonathan, what's the technical picture looking like for you on the oil price?
On the oil price, I just think if a trend's going to develop, and let's see what happens with the data tomorrow night, then I think you can quite happily add to positions on a break through that 82.50 level, because I think if a trend's there, it's going to commence, and it'll break on a new high will be where you want to be with it.
You talked earlier as well, Jonathan, about the impact of China and the outlook for them in terms of that oil picture and the pricing picture. China's pretty key to the gold outlook, it would seem, at the moment as well. It's been talking about allowing more trading. How much do you think that could actually change the demand picture?
Look, I think that's going to be quite interesting because I think within China you start to to relax some of the laws to some of the trading, then you should see some demand. Now, China is quite volatile in terms of its inflation forecasts and the way prices actually move. So I think if you start to open the gates to allow more people in, more people to invest, then I think because supply and demand for gold is always in a little bit of a balance here, then that demand will help prices, certainly not any dip, but also help prices start to trade higher.
Peter, is there pent-up demand there for gold? Or?
Always in the third and fourth quarter and in the first quarter, Brooke, as the seasonal demand increases. You talk about Diwali, you talk about Indian wedding season, you lead into Christmas. Then, of course, you look at Chinese New Year and then rolling into Easter and Ramadan very shortly. So all of those major factors will contribute to we think, more demand for gold. And we wouldn't be surprised to take, 12.10, 12.20 out very, very quickly. Went through 12.03 last night.
Within weeks then, obviously?
Oh, I think so, definitely.
And Jonathan, what about you in terms of where it could head from here then?
Yeah, it's the same thing. We've got that seasonal demand coming up, and we had a look at 1200 last night. It's been going relatively well for the last 3 or 4 sessions. I tend to agree with Pete that looking at 1220, I think, is well on the scales. So yeah, I'm looking for high prices.
Let's switch our attention to wheat as well. Peter Maguire, a 60% gain in less than 2 months. I think it's up something like 70% from the lows. There's obviously concerns about Russia limiting or indeed banning exports. Is this the kind of trade you just get out of? 60% jump in 2 months?
Not really. Brooke, a couple of things. Remember, a little bit before your time, I would say, certainly not Carson's, but the 1973 grain robbery.
You know more than I do.
The great grain robbery.
We'll get back to that.
And this is the great challenge that what happened with Soviets buying the US stockpiles in 72, 73 saw a super spike in wheat, corn and soybean prices. And what's happened now, we've had record high temperatures across Kazakhstan, the Ukraine and Russia. And that's putting all sorts of pressure on that whole complex. And we've seen dramatic price spikes. And I think there's more upside yet. I wouldn't be surprised to take 850 out in the short to medium term. I'd say before the end of August.
But it seems that even in my time, it does seem that you get these events and people will start saying, oh my goodness, where is sugar? Perfect example. And you get people saying, where is Egypt going to get their wheat from? They're the biggest importer. We're going to have a shortage of food supplies right around the world, and you get these kind of crisis talk happening, you get the panic buying, and then maybe the government comes out to say, oh no, we're not banning exports, and then it all subsides again. You do get these things happen and we move on.
That's the commodity cycle for you, and we had that also in 47, 48, those super spikes. But if you look at, yes it is, but inflation adjusted terms, wheat's still incredibly cheap when you look at those super spikes that we've seen. So the fundamentals are there. We're talking about Mother Nature, Brooke, and all of those factors at play at the moment are driving prices higher. And we're worried about the floods in Pakistan, and certainly that Russian region at the moment is a major concern.
Jonathan, can I ask you, are these sustainable kind of gains? Is this a legitimate reason for a 60% spike in 2 months?
I look, Brooke, it is quite hard to see how these prices will continue to trend. When you look at world ending stocks, we're going to see a shift in them, and that is a concern, but we're still on record levels for world ending stocks. This will cause a dent in them, and perhaps a dent leading into 2010-11 crop. It's always hard, and I tend to agree with Peter that it is hard with these spikes in commodities, where they just move so quickly, because at the moment you've got a lot of people looking to make good gains in a trending market. So you've got the natural fear, but also you've got those funds, those CTAs in America that are saying, look, this is a good trade, let's run with it, and so their prices just can continue to trade higher.
Brooke, exactly, Jonathan. And, a lot of the smart money jumped out of gold. They've looked at the other markets and they wanted to buy into markets that were moving. And the hedges and CTAs, as Jonathan said, have ramped this up. And it's been a fantastic trade to pick up 60 or 70%. You talk about the leverage when you buy with futures. The returns would be enormous. So it's been very, very good for that whole sector, and the retail sector is also involved.
That's interesting. You're saying they've kind of shifted money. It's not even new money coming in.
I would say not.
Okay,
just shift from certain trades, and this will exhaust itself. The shorts will end up, it'll come back to probably $7, $6.50 in the next month, and the smart money will jump onto something else. The commodity sector has had some very, very aggressive market moves in the last 4 weeks. Have a look at crude oil. Think what happened with gold to go short from 1260 to 1160, Brooke, and then you look at even sugar's been good.
Yeah, no, Jonathan, you've been watching that rice price, and we've been checking with you on that one. That's posted some pretty good gains as well.
that certainly is. I guess with it's more the floods concerned in China, but I think the key element, I think, which we've all got to focus on is how is this going to affect inflation? You know, wheat at 2-year highs, you know, copper at 3 months highs. This inflation, this could be a concern for those countries that have inflationary issues, particularly, say, Australia. So this could ignite some inflationary pressures, and in my mind, I think that they will. And I think that's something we've got to be a little bit cautious around, because I think interest rates on the back of that can move higher.
Yeah, sure. And final thought
Exactly.
from Peter, yep.
I agree with Jonathan completely, and food price spikes. The emerging markets is where the pain's going to be felt. We saw the Philippines have food riots, and we saw Mexico in 2008 with corn riots. So we could see the same within the next couple of months.
Yeah, we're already kind of hearing it from the industry, and it seems to have caught everyone off guard, particularly that wheat price. Thank you so much, Peter Maguire. Great to hear from you again. And Jonathan Barrett from our Sydney CBD studio. All the best, guys. Thank you.